Another week, another all-time high on the S&P, but what is the economic data telling us? Yields continue to trade in a line here, and it's not really telling us much, but many people are seeing signs of inflation. What are we actually seeing, and what is the bond market telling us? Nvidia or Apple, which name should you be looking at, or should you be looking at either? Kohl's, is this type of move in XLY a fluke, or should we start looking at these names? Crude oil, is this the correct hedge right now? Uranium, how much higher can it push? We have a ton to go over. Let's get to it. Hey everyone, what we're going to do is drill into what is actually happening. I see a lot of conjecture out there right now, and I get it because there's a lot of uncertainty. But the bottom line is there as much uncertainty as we think there is? So if we just start with the S&P on the weekly, and we look at where we were, and we just very simply see the breakout from February, we broke out, and since then, 1, 2, 3, 4, and we're just pushing higher. And we're all out here and we're all waiting for this, well, quote, shoe to drop, and it's just not dropping. So this begs the question is, what's going to get the market down? Is it going to be earnings? Is it going to be anything dealing with the inflation side? Is it going to be tariffs? What is really going to get us where we're coming down? We're going to cover some of this today, but I think it's important to say, what is the market telling us about what it thinks it's going to happen? Remember, the market is a discounting mechanism. And if we take a look right here from the January 22nd, 22nd to December 21st, we can obviously see how we held right in this area. And from there, we just have been ripping. To the point from when we paused that if we really just took a step back, and I do this, counting not only the red days or the red weeks, but how much did we actually drop during those red weeks? In other words, not even just looking at the bars, but since we all got liberated from the liberation right here, when they said we're going to pause everything, how much are we actually down on those weeks? In other words, how much are we down here? And I'll show you how to do this. You just measure it, and you're just getting a sense of like, okay, well, when we sell down, how much was it that week? Well, it was 4%. Well, that was a pretty bad week. Okay, and then how much was the next red week that showed up? Oh, that was 3.3%. Okay, that was bad. Was it as bad as this one? All right, so you're just starting to go to them and take a look and go, well, this one was 2%. How much? How about the next week? And you're going through it, and what you're saying is, okay, this one was 1.8. So even when we're red, the red weeks are getting what? Very different than what we dealt with going through here, where they actually started getting worse, settling down, looking at, right? It's very different, this setup. It helps to understand that people are actually buying these dips. And eventually they just go away because you just keep ripping. So I do get all the fear, but we have these patterns, and when we see them, we should just pay attention to them. It just makes our lives a little easier. And we can see it here again. Here we are, that pandemic level, and we came right to that level. And this is when we had that max fear, and everybody was going to, the whole market was going to crash. And what happened? We had peak CPI. And then from there, we just lifted. And it wasn't very easy to understand, but you can see the strength of the market. And again, we know what this level was. This is where Itchy came out and said, hey, I'm going to stop raising rates. Maybe this was a bad idea to inject 1.7 trillion in the market, and maybe I shouldn't have raised rates higher and faster than any time in U.S. history. Maybe we're going to break something, so we're going to stop. I'm probably going to cut rates. And then it took them 18 months to figure out how to do that. So when we look at these areas, we're just seeing the same patterns over and over again. And I do think it's just important to get that. You have the same level back here in 2015, and we came right to that on that pandemic level. There's your low, and then we came to this top, and there's our low, and then we came to this top, and there's our low. You should be able to understand this, and you should be able to see how this is happening over and over again. I mean, we all know that the break back here as well, and what happened from that break and from when we had the great financial crisis and how it lifted. All we need to do is understand that this is what's happening, and then we have to figure out how we're going to profit from it. And let's take a look at what the market's actually telling us about inflation and how they're positioning themselves for inflation. But the most important thing that we should be taking from this graph, whether we're looking at this as a daily graph or a weekly graph, or even if we look at this as a monthly graph, and you'll remember when this formed, if you go back and look at our videos, you'll remember that when this happened, we stated very clearly this acts as a slingshot when you flip it, and you're flipping it, and now you're in this position. Now we're not there yet because we have to go through this week, but we're in this position where we're getting that 3 white soldier position where you have the white bars over and over again in a row, which is a very solid bullish signal, and we're getting it on a monthly chart. It's very rare to get these kinds of signals, but here it is. So we can say that this should happen or that should happen and this is bad or that is bad. Or we can look at what's happening here. And when you'll see later, this is happening all over the world. Now, the single greatest indicator to look at, if you want to see what's going on with inflation, you look at short-term yields. I like looking at the long term because I want to see the 10-year and how it's tied to everything. But if you really want to see what's going on with inflation, nothing moves faster than a 2-year bond. Just the way that it is. Why? I don't know. It just is. So it seems to be that is the area that they focus on. The 3-month seems to be too fast for them to really care, a 6-month or year. But the 2-year, the idea that you're locked up into an inflationary environment, that's always bad. And you'll remember we went through all this where everyone was showing you the 2-year divided by the 10-year and stating over and over again that, recession is coming, just like winter is coming. And it's one of those things where it just never happened, or if it did happen and we went into recession, they didn't tell us. You have this pattern up here where from March 23, the breakdown, where they are just buying, right? They have to get in right away because surely, Powell's going to do something about interest rates with us losing all the regional banks. And then, surprise, he didn't. And then we just have the pattern. But it's very clear what's happening here, that this is getting lower and lower and lower. This is not signs of people thinking inflation is coming back. What you're seeing here is what you're seeing right in here where, let's clean this off for a second. But what you're seeing here is very similar to what we saw in here, where you're just starting to turn and roll over. And then we went through a zero interest rate or ZIRP environment. And then, you're getting 13 basis points for 2 years. So where are you going to put your money? And then, of course, we have the, the great awakening of Itchy, where he just decides I'm going to raise rates faster than any person ever in human history. And obviously, we just go from 34 basis points to the high at one point here, just off that route was about 5%. So shocker, something broke. But if you look at this is not something that's telling you that inflation's here to stay. And if we clean just this off for a second, and I'll just drop this down. So this is an Ichimoku cloud, and I do use this let's just turn this way up so we can see it. For more planning, do I trade off of it? Sometimes, but I have other clouds that I like that are a lot better. But to actually plan and see what's going on with yield, I find this very, very helpful. So if we are to go through environments where they have raised the yield or lowered the yield, and that because of inflationary environments, you can't miss it. You can see this through 03, 04 and how you acted, and you can see it over again here on 19 and how rates collapsed. You can see the turn of the color right in here. And you're just looking for a couple key things to see, are yields going higher, and is this remotely bullish? So the very first thing you do is just say, are we above the price? Now, this green is a lagging indicator, and are you really above that? And the answer to me is, if I just drop the pin, you're kind of on it to under it, is what I'm going to say. So I don't really view that as bullish, meaning are yields going to rise? And then I'm always looking to see, is the blue line above the red line? And here's your blue line right here, and here's your red line. I did a whole video on Ichimoku Cloud. It's actually my most popular video. I think you can just go and find it on the internet or on YouTube somewhere. But this is how I use it. Everyone should use it how it's comfortable. It took the guy 30 years to build it, so maybe give it more than the weekend. But the red line right here is telling you very clearly you're okay, but the blue is supposed to be above, and I'll show you this maybe later in the video where you have like a perfect one that's just setting up. So there's nothing about this, and the cloud's supposed to be green, the cloud's red. Nothing about this is telling you that you're going to turn or that you have any chance here of going higher. Like, does that mean that they're going to cut rates? I don't know. And you know what? Neither do you. But they keep talking about it. And if they start, this will go lower, obviously. And the market will probably go higher. But from our standpoint, you're not seeing any inflation. You're not seeing any signs of inflation. If I overlay this with the S&P and you look at what happens when they start raising rates like they did here, you start running into an area where you're going to have a problem. And I can open this up a little bit more. But all that's happening here is that we're going higher and rates are staying stagnant. And we can see this playing out over time. You can see it here, the pandemic, absolute collapse, and then you just have ZIRP. And just pick an area of any time where these rates were collapsing, and we know why. And then what happens when they start to bottom out or base. It's the basing and the certainty that you want. Now, whether they raise rates or cut rates, or as long as they're not doing it with a hatchet, it's not really going to matter. And it's the planning and the certainty. And the one thing you have to say about the market right now is we're getting more and more certainty. We are getting these tariff deals, whether we like them or not. We are getting more understanding of when the Fed is going to cut rates. We are getting more understanding of earnings, and we're going to get into some of that shortly. But overall, you're getting more and more certainty every single day. And you might not like what you're getting, but you're getting certainty. Now, in front of us is just an S&P weekly, and I just put these lines here just so you can get a semblance of where we are as regards to where we've come back down. And then below is just a momentum indicator, and it's just straight up momentum. It's really very simple for us to look at this and say, what are we looking at? Momentum, straight up. And it's not RSI, it's just Williams. And it's very clear, very straightforward. This is momentum. Do you have it? Do you not have it? And you can see right here that you're either, yeah, we have momentum, or we don't, and it's collapsing. So here we go, and we all get liberated, and then we lose all the momentum. And then the momentum just stays. See how it just stays here? That's all you're looking for. Do I have momentum or do I not? Yeah, I've got momentum. All right, cool. That's it. And then you can start seeing the tests of momentum. You can start seeing the drops in here. And you will see it actually fall off a cliff before the market continues its descent. Just like you saw it here. This actually will crack before or into the crack. But as long as it's doing this, you don't have momentum. The bottom line is you have momentum here. You're not seeing any of these telltale signs like you did here in July 23rd, where you came back in, like you did December 21st and you came back in. You just went through it and you're just sitting here. Is it a lagging indicator? You can get caught in it and then have it happen. Yeah. But as long as it's down, and it starts to build before it goes back up and stays there, that's what you're looking for. So I'll give you some examples of this. Even if you go back and take a look at the great financial crisis in here, you'll see, if you look in these areas, that you actually had signs of this where it's like, oh, okay, and then we're sideways, and then, well, we collapsed right in here. And you're like, well, that's not really that big of a move. No, and that's like a sign. Here you are again, and it collapses. Here you are again, and it collapses. So it's telling you, hey, there are some issues. We don't have anything like that. This moved down when we all got liberated, and now it's stopped. This is really important for us to get. And I really want to hammer this home. If it starts rolling over again and you start getting these cracks, you start paying attention to it, just like you did in April 24, just like you had happened in August 5th when Japan came out and did what they did with rates. You're getting signs of that, and then you're bouncing those signs back. But even those are nothing to the date that we got liberated from. So we want to watch this, and we'll keep it on watch, and this will give us signs of, do we have an issue out there? And right now, candidly, we just don't. Now, if we look at this longer term, in front of us, I call this wants versus needs. And why? Because that's exactly what it is. It's wants versus needs. XLY versus XLP. You need soap. I hope you need soap. And XLY. What do I want? Do I want that fancy cruise? Do I want that new car? Right? That's XLY. Do I need that widget that Amazon's telling me I need? Wants versus needs. And if we look here, you can just see that, oh, okay. Now, how did we roll over here? Well, we started flattening out back here in 07. All right. And then we collapsed. Okay. And if we look at these little levels, it'll dictate what we're seeing. And are you seeing any signs here at all? They're buying consumer staples over buying the things that they want. I mean, sure, people need Clorox, but candidly, they're buying the widget on Amazon. If you overlay this with something as simplistic as just RSI on a weekly chart, you can see it, and you can see the telltale signs when you might be running into an issue. I always look at it from this perspective, and I'm just using lines because I think the line's cleaner. It doesn't matter to me if you use the candlesticks or use a crown. I could care less. But if you kind of look at these little widgets, they'll tell you, and this is why I like RSI. See, when you understand RSI and you understand how it's actually calculated, there's a book by Wilder that actually, he's the guy that created RSI and created ADX. And when you understand how these calculations are, you'll understand why you actually care about this stuff. Instead of just saying none of it works. I always go back, and what always helped me with this stuff was learning the calculation, not some guy even like myself on, Twitter or YouTube saying, none of that works, technical analysis doesn't work. Okay. But when you understand what they're actually calculating, it does work if you know how to utilize it correctly. It's what always made me laugh about the Ichimoku cloud. The guy spent 30 years putting it together, and some guy's going to tell you, from his mom's basement eating a Hot Pocket that it doesn't work because he spent an hour on it. But if you look at some of these like higher highs, and then you have your lower highs here, it's telling you that the directional movement of this is fading. And there's a bunch of these correlations I'm going to show you today, from Apple to Nvidia, and how to compare where the money's going. And it's absolutely fascinating because it does tell you where the inflows of capital are going, and they don't go there if people are concerned. And this is really important for people to get. And you know what? I'm going to segue for a second. We're going to segue. Hold on. All right, so this is the cover, and I just grabbed it off the internet real quick. New concepts in technical trading systems. Wilder. Okay. Super, super important to get this. Really important because it explains why you might want to smooth it out. It explains, he actually shows you the calculations. He didn't even really use charts. He just used the numbers. It's kind of insane how good he was. But it's definitely, it reads like putting a stereo together, or IKEA instructions. Like it's going to put you to sleep. But it's really good and it will help you. So, and this is my point in getting into this. And this is what happens. I like doing these videos raw like this and unedited, and I'll tell you why. Because then it shows me where to go to correlate things, and that's just how my mind works. So like when I'm showing you this right now, my mind's already thinking about giving you an example on where they're throwing money and people are they're not getting it. And when I say things like that, it's just because I've been doing this forever. Like I've been doing it 26 years, like straight. So, and it's not like I got my teeth kicked in so many times that I know what to look for. We did this trade in the community, and I hopefully I mentioned it already in this video, but if you're trying to get into the community, please get on the wait list. I believe the next batch that's going out, there'll be 5 days left for those people that are already on the wait list. So do check your email. But in this area, we got involved. And this corporation was trading, SLG, this corporation was trading, and it ties right into when the regional banks blew up, was trading at 30 cents on the dollar. 30 cents on the dollar, literally tangible book value. And everybody's calling for the end of the world. And what happens here is everyone just pukes it because no one's ever going back to New York again, their New York office space. A office space, meaning the type A. No one's going to New York again. The sky is falling. You guys know this all through, like when I talk about reflexivity and when I talk about, outcome versus expectations, right? The sky is falling, the sky is falling. And then this move right here is Japan coming out and saying, hey, 245 Park, we'll buy 50% of that for $2 billion. And essentially marking to market their entire book. From that point on, you never broke that level. And we wound up doing exceptionally well with this trade. And guess where it went back to? Above book value. You're seeing this in the XLY space right now, the same trade, right? It's just same soup reheated. So you're seeing it, for example, in things like ANF, where ANF is trading at this huge discount to its PE. Like it's insane where this is. Why? Because of the tariffs. And it boils down to the same thing. You have a what? You have an expectation that the stock should be here. And the outcome might really be here. And it's a difference of trying to understand, like, why is the stock trading 8 or 9 times earnings? And of course, you have risk, right? You have uncertainty of tariffs in China, Vietnam. You have reasons, but it's up to you as an individual to cipher out those reasons and say, hey, maybe it's not 92, but is it 120 or is it here? And that's no different than what just happened with tariffs from April 7th on. So as you get certainty, these XLY names, they're not exploding by any stretch. They're just not. This is super interesting to me because I'm watching it happen with something like Kohl's. And people are looking at Kohl's and going, oh, well, this was just the short squeeze. Well, when people actually look at the book value of Kohl's, it's $34, $35. And people will say, oh, it'll never get back there. Once you're through the tariffs and you understand the risk of the tariffs and they unwind that with Kohl's, that's why Kohl's is doing what it's doing, but people aren't getting this. So when you look at something like this and you go XLY divided by XLP and you're like, well, how high could this possibly go? And then you look underneath the hood and you're like, well, ANF is trading 9 times earnings, right? I mean, it just is. It's a fact. Sydney Sweeney's going to wear a pair of jeans and the stock just moved 20% on a pair of freaking jeans. So when you connect it, like, is this stuff ready to move? Is it not? Not all of it. Not everybody's going to go out there and win, right? If you're selling $100 t-shirts to men to go work out, one, email me because you have issues. But like, the other thing about it is, like, no, that market strategy is probably not going to work. So not every corporation is going to benefit from that, right? But 2, you're going to see some sense of certainty here, and you're starting to see it here with something like a Nike, where all of a sudden they're going to benefit from what's happening. And we'll get into the benefit in a second. But you're going to have levered companies like you have with Kohl's. Like here, take a look at this. I can't go through the whole thing, and this is the best I'm going to be able to give you right now. So I'll just read it. We update our estimates for minor adjustments. This is on Kohl's, following the company's 10Q release, such as interest expense, share count, among other things. We also adjust our estimates to reflect the impact of a 30% China tariff, a 20% Vietnam tariff, assuming August 1st implementation, 19% Indonesian tariff, assuming August 1st, and 10% ROW tariffs. So Kohl's, they changed their estimates on Kohl. This is from Goldman. And what they're saying is, we're estimating what this is. And what are you getting to? Where am I going with this? Outcome versus expectations. Is this really what we're going to get? And if so, if this is really what we get, is their expectation of how it's going to affect Kohl's exactly correct, right? So this is when people talk about the market's efficient, I just kind of laugh. This presents massive opportunity. And when you look at how do they think it's going to affect Kohl's? Year one, this is what's going to happen to their earnings based upon it. Year two, year three. So they think no company out there is more affected. This is what Goldman thinks. No company is more affected by tariffs than Kohl's. If you go through their entire piece on this, which is like 17 pages, which I'm not going to do with you. But if you went through this, no company is greater affected by this by Kohl's. And please comment. I do like going off on these rants because I do think it's really helpful when you look at like an XLY chart and go, well, why do I care about the relationship to this? And why, what's the underlying driver, right? Because you're pulling this stuff out. All right, let's just keep going. And so this is what they did with it. They left it as a sell, Kohl's, but look what they did with the price target. They just raised it by 40%, which I think is interesting. It's a 40% increase. And then they show you the new numbers on where they think the company's going versus the old numbers. And it's pretty staggering where you're at. And it shows you those decreases that we just talked about. Again, why do you care about this? Expectation versus outcome. Now, to be real clear about this, I'm not saying that this thing's going up immediately. This stuff takes a lot of time. You get the fervor. This might have marked the top for months on something like this. And maybe these tariffs are even worse than we think they are to these companies. But I don't think I don't think that's likely. And the point of it is to understand, and when we go back and bring this full circle, is why do I care about this? You care about this because even if you looked at something like a Kohl's, you're like, I'm not doing it. That's not my bag, baby. Then you would look at this and go, all right, well, that's cool, but I'm not interested in that one. I think Starbucks makes more sense because I don't have to deal with apparel. I don't have to deal with anything. And then you would look at this RSI and you would run away screaming, but you might look at Nike and go, yeah, I get it, but this might make sense and I could base in here. And you might just say that I don't care about that one and I want to go take a look at what's going on in the beauty industry. Either way, you're pulling threads. I'm using my hands showing that you're pulling threads, and then you're seeing where it goes. All right, let's keep going. Before we go any longer here, understand that tech divided by XLE is about as clean as you can get, guys. XLK divided by XLE. I did a bunch of these. I'm going to do more of these today. This one's going to be a long one, I can tell. You got to pay attention to this. If you want to say hey, what's the one? What's the ant's pants, right? What's the monkey's banana? This is the one that you have to pay attention to. This is the cat's pajamas. Why? Because it's tech growth versus value in and of itself, right? It just is. And so when you're looking at this, I always find great value in taking a step back and turning it into a line. And that's why I show it this way. And I do have a really good trade that I wanted to show today, but I'm going to have to do it in another video. Now, if I take this line and I overlay the XLK on a monthly chart, the S&P, it doesn't get any clearer than what the market wants. We did exceptionally well in here by understanding this turn. When we're in the community, and I was posting them on Twitter, we were buying BPT at $4 and selling it significantly higher because we understood the turn and we understand what was going to happen. You can drop this into different time frames and use it in different time frames. See what I'm doing here as I'm just dropping it in the different time frames, and then you'll see it. Oh, look, a head and shoulders. It's not rocket science. What happens when the XLK broke January 22? That was it, guys. That was it. That was the end. And you can see the structure and breaking. And then you can watch right in here and say, oh, you mean when November 22, when this bottomed, that was near the bottom of the market? Yeah. You want to really pay attention to this. And what you can even do with it, if you look at this little level, watch what I dropped the RSI on it. Oh, look, a coincidence. See how you took out a lower low and the RSI made a higher low? I have a divergence, don't I? All right, stay with me. Let's review XLK, XLE, and let's look at it super quick over what we need to look at here, which is what? We're going to just use an Ichimoku cloud. And I'm just going to run through what you should look for. Is green above the price? I would say we're in line with the price on the daily. Is price above the red? Yeah, price is above the red. See, if I work these into these, I think you might start using them a little bit. Is blue above the red? Yeah, we got that going for us, so that's good. That's nice. Price above the cloud. Here's the cloud in neon green so we can all see it. It is. Is the cloud red to green? It is. This is telling you that you're going higher. All right, let's get into it. Now, I thought this was fascinating and I wanted to share it because you don't really see stuff like this too often. I can't really remember the last time I saw something like this where it's this skewed. So you have this indicator summary, and what it does is it takes all the short term right here and it takes all the intermediate and then it ranks them by how optimistic or how pessimistic are they on a category or a sector. And so if you were to take volatility, are they optimistic about volatility now, or are they pessimistic about volatility right now? And so you kind of dig into it from there. And what it does is it just gives you a sense of, hey, how are people feeling about that asset class? So right now, you have people that are very optimistic that volatility is going to get what? More bullish, which would mean more volatility. You're not seeing that, and here you are on an intermediate side as well. And then if you look at the breadth or surveys, or you come here and you take a look at this 17 right here, which is pretty glaring, they're very pessimistic right now, aren't they? Let's take a look at cash. Right now, they're at a 90 on optimism for cash. Hedging is at a 75. So let's just take a second and just look at what are they the most optimistic on. And we're just going to focus on the intermediate side for a second. We can look at this, but they have more on the intermediate side and roughly the same thing overall. But they're optimistic on volatility, they're optimistic on cash, and they're optimistic on hedging their portfolio. Just think about where the market is and think about what they're optimistic on. And what does that tell you? That you have a lot of people that are still very afraid of this market. That's what this is telling you. And as they're saying this, the bond market is telling you something just completely different. And it's worth noting. I don't try to spend a lot of time on the bond market, but the tail doesn't really wag the dog. And we all talk about the stool, but really the bond market moves on the macro. And I'll show you what I mean. But before I get into that, I want to walk through this because this was fascinating. Again, some of these data points are so out of skewed that when I talk to people that have been trading a long time, that have been in the community, and if they've been trading for like a decade or two, you have so many weird skews going on. We don't know when you see these things, you don't know what to do with them. Like, for example, all countries with a positive 252-day rate of change, meaning if your rate of change was 0, and then you flip your rate of change over 0, we should be familiar with rate of change. We've gone over it enough in these videos. If you're doing that, what percentage of countries have a positive 252 rate of change? And then you say, oh, well, right now, you're above again versus where you were. Annualized return, 16.9%. Okay, how many times does this happen? 40% of the time. Okay. Since 1969. So they're broadly buying the market and nobody's really concerned. And I'll show you what I mean by this. To be clear about this, you could go through and take a look at world ETFs. I have a whole watch list on world ETFs. If you want, just comment and I'll drop it somewhere. If you want a copy of it, I put it together. But it has all the world ETFs and you can start clicking through them and take a look at them. We go over them publicly in the pre-markets too. Sometimes people will ask about them. But it's absolutely fascinating that what about the tariffs? What about 2 wars going on? Whatever, boomer, we're going higher. Okay. And I, like everybody else, I'm waiting for the shoe to drop. I'm waiting because, quote, we're over leveraged, and we're going to get to that suck salad in a second. But right now, if we take a look, credit default swaps. Now, for those that don't know, this is how I want you to think about what is a credit default swap. Just think of it as insurance on a bond. That's it. It's insurance on a bond. And this is really where the great financial crisis kind of got into a little bit of an issue because everybody that bought the insurance all bought it from AIG, and then AIG didn't have the money to pay. So, oops. And that's why, long story, very condensed. That's what happened. But with credit default swaps, what's important is, are people afraid of their bonds? Are you afraid of your bond portfolio? Are you scared? Do you need protection? You don't need protection. Okay. So when was the last time you were this long below your moving average? And it counts the days down here. So consecutive days below this moving average. Okay, you are now going on 50 days below this moving average. And when you start to really focus on that, what is that telling you? Well, here's what's so important about this break, because you can time the market right here by when the market rallied. And if you go back and take a look at October 23 right here, 2023, go look at when the market rallied, when you broke this moving average. It's not rocket science. If you think about it this way, if you borrow money, if you went out there and you had to borrow money, let's clean all this off. And I'll tell you why it does this, because I think the why is super important. I issue a bond, that bond's 5%, but they don't trust me. So they go out and they say, we want the 5%, but we need insurance. And the insurance is 50 basis points. So now instead of me paying this 5% right here, I say, okay, well, I know you have to pay 50 basis points and I need the bonds. So I'll give you 525. I'll split the 25 basis points with you. I'll eat 25, you eat 25 on the insurance side. Something like that. They negotiate that. They put the offer out there, and they split up the difference so that the institutions will buy their bonds. They get their yield. They get their loan. The corporation gets their loan, the institution gets their yield, right? Got it? Good. So when you see this, if the insurance is cheaper, companies make more money. If the insurance is cheaper, companies make more money. Why? Because their borrow is cheaper. If you go out to borrow, look at these convertibles people are doing with zero interest because they're not worried. And they haven't been worried since April. As we all sit around and argue about tariffs and the cost of gold and two wars, people that are buying bonds are like, yeah, we don't really need any protection. We're good. Things are good. And you can always look at MOVE, M-O-V-E, which is just like the VIX bonds. But this is very important to get this before we go any further. We have this dichotomy where people are afraid, people are volatility. You'll hear me on these calls during the weekday where I'm like, I don't know, man, I think there's another shoe to drop. And I keep saying it, we keep going at the highs and our swings keep working, our day trades keep working, the long-term positions keep working. You know, I keep saying it, you put one foot out the door just in case, but I don't know what's the thing. Now, is it going to be inflation rearing its head? Maybe, but, you know, crude's plummeting. Silver's plummeting. We're going to get to that in a bit here, but when you look at credit default stops, they're telling you a real story about trillions of dollars, and they're not concerned. So let me show you what I mean by this. Here's credit default swaps, and here's the S&P in black and blue here. And if you take a look right there, or any of these peaks, where it then rolls over, and you just take a look at what happened in the market during any of these times, and of course you're going to have it right here. Of course you are. I didn't go really nuts with this, but I just thought it was worth people understanding why this is so important. Because it literally, here's October, mark the bottom, credit default swaps. Oh, they're gonna stop raising rates? Credit default swaps collapse. What happens here? Market rips. Why? Borrowing is cheaper. And people could not understand for the life of them why the market ripped when they weren't really doing anything with rates, because they're looking at the equity risk premium. They're not looking at the cost to borrow. It was all in the cost to borrow and people didn't get it. That's why earnings were going up. Now you know for next time that you see this. Whenever you have an environment like this again, you'll be like, oh no, it's the cost to borrow. It's not just cutting the rates. That's the equity risk premium that's going to matter, but earnings are actually going to go up if the CDS drops. So if you take a look here, it's the same exact thing. And then what happens? I mean, literally, the CDS, if you take a look at this and you drop this, the CDS at that day, and I'll clean all this off so you can see it perfectly, because people always say, and you look at the VIX, but if you were to look at CDS and say, when CDS peaked and it put in a low or put in a high, that's the bottom of the market. You can almost time it that's the bottom of the market. It's kind of crazy if you think about it. This one, not so much, but you get it. You're very, very close. I think it's important. I think it's important to get this stuff. CDX, credit default swap. Now, one of the other things we keep hearing about is the borrow out there. How much money is out there to borrow? Well, first and foremost, this is Sentiment Traders, not by me. And I just think it's important to give them credit. I have no affiliation with them whatsoever, but I've talked to them before and they're fine with me showing them. New York Stock Exchange debt, percent of market cap. So you have the market cap out there. This would be your market cap of all the stocks in the New York Stock Exchange. And then the percentage of those is going to be this number. And what you could see from the past 12 months right here is that you are at your highs. So that should be something we should be concerned about. But is it? Is it something we should really be concerned about? So if we take a look at the market and you get this really nice trajectory on the market from here over, and you can say it for yourself. I mean, it's just like, okay, we're straight up as you and I all, argue about everything that's going on out there. The market just keeps going, well, we're going higher. And we look at how we kind of came off that margin on a basis of market cap, right? Not growth, it's market cap. If the market cap went up and margin stayed the same, just understand that. So if market cap goes higher, so market cap is going higher because the market's going higher. And if the debt level stayed the exact same, you're going to drop because it's a percentage indicator. Just understand that when you're looking at this, right? It's not an absolute, it's a percentage. And that's the difference. Let's get rid of this so that you're not confused. So that, if the market dropped and it stayed the same, then you're going to go higher. So as the market drops, okay, that's what's going to happen. If end margin stayed the same, that's what's going to happen. Just understand that. Now, if we look at this, what's it telling us? Well, in the past 3 years, you were higher. You were up here at like 1.6. So is it something that we should be saying, oh boy, we're at year highs on the market cap? This is where it gets super interesting. This is 5 years out. This is 10. And we can see that you're starting to get that level where you were leveling off. Now, this is exactly what we were talking about. See how we're leveled off and leveled and going right on that line. And at the same time, the market's going higher. It's only one way that could possibly be happening. They were adding the whole time that was happening. So what are they doing in 18 as the market's going higher? and this is dropping. There's only one thing they could be doing into the pandemic, getting off margin. So it's telling you that you might have a little issue. Crazy how that looks like a little blip now, isn't it? And if we look at this going forward, what happened here in 24 and 25? On a percentage of market cap basis, look at these lows. Now here's 20 years, and that's what 20 years of New York Stock Exchange margin data as a percentage of cap market. And here's the all-time. And this is the one we're going to focus on for a second because I think it's super important. And the reason I think it's important because it puts it into historical valuation. I can actually go back to the 60s here. But so here's where we were at, and if we come straight across, look at that level. And it really puts you back into 01, 97, 98, 99, coming across 2003. And that was your low. And where you're at here, historically speaking, versus anything else is kind of crazy when we look at it on a historical basis. What I would suggest is that if you took this level here from 08, we had basically free money, until you got rid of the free money, and you looked at that level, you're roughly, let's call it 2, but you're not. You're like a 1.8 to a 2.3, something like that in that area. Look at where you are now. You have so much more room that you could go on a percentage of market cap before you're even back to anything from 07 to 18. Now, the argument could be made, is that going to happen because of what's going on with the Fed funds? Are you going to get back to there because of the borrow? And the answer is maybe not. Because if you don't have, ZIRP, zero interest rates, then are you really going to get back to that amount of leverage? You might not. Why do you care about this? You care about it because if you're looking at this and saying, there's so much money in the market that's on margin right now. Not really, no. There might be a lot of money on the market relative to where interest rates are, but that's not even the case because you're right where you were in 2000. And you know where bonds were back then. You know exactly where bonds were for the 10-year was back here. And you're roughly at the same area. And is there anything really to this? And the answer is yes, there really is. So if we take a look right here when we broke, and I just put 100 moving average there just to show, because I thought it was interesting. So if you take a look at this area in 19, and this is obviously before the pandemic, and you can see them coming off of margin, you can start seeing how it got harder and harder in that little window for us to really go anywhere. So they were coming off margin before that because of tariff 1.0. Everyone was nervous during tariff 1.0. And that's exactly that time period. So what is this telling us? Well, it's telling us you have a heck of a lot more room to go to even get to average. And if you're down here historically and you start adding, the market goes higher. So there's a lot more ammo out there than people think there is. And this completely is the point that I'm getting at when you look at that first slide we went over when we started all this. Remember, people are out there saying to themselves, we're going to have some huge volatility. Let's look at the VIX in a second here. We're going to have some huge volatility. Look at the amount of cash that's out there. Market's at all-time highs. Now, if we look at the 10-year real quick here, we're going to see this area. And this is exactly where we are. Captain Obvious, right? But this is 08. And you can see all in here. We're same area. So when we look at the margin rate, it is what it is. The margin rate on a percentage cap basis was higher at periods of time throughout here than where you are here at the same rate. So you're not even at the same rate yet. So there's a lot of room here with margin. Now, if we take a look at this from my side and look at the VIX, and here we are on the weekly, you're at a 14. So you're breaking the 15. You're actually breaking down on the VIX. And meanwhile, we're out here saying this shoe's going to drop, that shoe's going to drop. And I know a lot of people are going to say, this means that it's just a matter of time. You don't know that. You don't know that you're not going to go through a period where you're going to go back into 10s or 8s or 12s. You just don't know what you're going to get. So the idea that we just know that we're going to hold 15, we don't have a clue. And what I would suggest is looking at this. And the other thing when we talked about credit default swaps, we can take a look at what I mentioned earlier, which is called MOVE. And what MOVE is bond market volatility. And I've brought this up a couple times. And really why you want to look at this is think about this as buying insurance on the bond market as a whole versus credit default swaps. Think of that as insurance on individual paper or bonds. But if you think about this, you're just buying insurance on the entire bond market. Think of it that way. It's easier. We're falling off a cliff, guys. Like you're literally falling off a cliff. So no one's worried about corporations and their paper. Like nobody. We might be concerned about it. We might be waiting for the shoe to drop. But when we really get into it, you're at levels that, you're just not there. Let's go out on a week, and I might have to turn this into a line if it's going to give me something goofy. But can you go lower? Yeah, you can go a lot lower here. And the lower this goes, the more corporate leverage earnings get. Because why? Because they don't have to borrow paper. Just think about that as a conglomerate, right? Same thing with when we looked at the credit default swaps and we looked at the S&P. It's the same thing. It's just this is more of on a broader scale than an individual scale. I think this is really important for people to get. But let's look at some correlations. Now, I always find it helpful to look at leaders with correlation and get a sense of where we're at. So this is the SOX divided by the Qs. And you're getting that on a relative basis. And we're getting it just to look at it. And here we are weekly. Okay, so we're up and then we're kind of pulling back a little bit. So the SOX relative to the Qs completely underperformed this week after outperforming. Let's go take a look at the RSI with this. All right, so we have the RSI right in here. And what we would have is we have a pretty clean divergence, right? Where we are at that level. And then, of course, you can just see that drop from here. So that's actually setting up for the SOX from here to lift. And then it undercuts. And then what happens from there, see how you lift out. And then you just outperform. And then you're hitting a resistance spot. And then once you hit that, you start to reject as a whole. And it's not crazy. Drop it to the daily. And then we can see that that has gotten to that level and that it's starting to roll over. And then we can see the same thing here. And candidly, if we drop that down to make it a little tighter, it's still there, but it's just not as strong. We actually undercut here. It's still divergence. It's what I refer to as a hidden divergence because it's there, but it doesn't look like it's there. Drop this to a 4-hour. And then what you can see on the 4-hour is pretty clear, in my opinion anyway. I'm just going to mark that off. I think that this is pretty obvious that you've obviously come down to that April level, but what we could do here is draw that a little tighter now in there and put that right on the spots. And then you'd have our level here versus where you're at. And you really don't have as much of a divergence there anymore, do you? So I'm going to remove that out on the 4-hour. But you can certainly see the divergence right here. And what is this telling you? Well, for me, what it's telling me right now is actually you're setting up for semis to go higher. Why? Because the SOX relative on a 4-hour is oversold. So this is actually telling me that at this level, and I don't really consider that a real big divergence, but it's there. So you're actually setting up here and being oversold, in my opinion, and that can lead to you pushing. And if you went and looked at these levels and said, well, when did we tend to lift? Now, here, I'll show you what I mean by this. Because you're like, what is he talking about? But let's walk through it together. I love when we do stuff together. Hold on. All right, so there we go. Put that there. And just take a look at it. And what I'll do is I'll get rid of this one just so we can dive into this a little bit more. All right, got it? And let's just put this here too. And then let's just do something simple after looking at this, right? And give me 1 second so I can think about this and how I want to look at this. But if I'm to look at this, and to get just a clear sense of it. What happens when we get to these levels? And so what I'm going to do is go over and we'll just drop a pin. And, from a pin perspective, I'll get rid of this and let's keep it in drawing. That'll keep it in drawing, right? And I'm just going to drop lines when we get to those 4 hours that are under here. And there's the divergence right there. And there's the end of the divergence. And here's the end of the divergence. And let's just see if we can find another sucker divergence. Find one that didn't really work. And you hit, but you weren't a divergence. But yeah, you're actually there. And then here's another one. And that's not really one, but that makes my point. All right, so we undercut on the 4-hour here on a relative basis. And what happens? We lift, we go sideways, we bottom, and then run. We fall apart, and then we run again, and again, and again, and here we are. Maybe you think it works, maybe you think it doesn't work. But to me, I definitely think there's something there, and I definitely think it's worth paying attention to, and I wanted to bring it to your attention. Now, if we look at these names, let me see these little spikes, right? And then you can see, obviously, the reversal here. So Nvidia divided by the NASDAQ, most important stock in the NASDAQ right now, hands down. It's not even close. And we can see our little hammer time right here, which is telling us that maybe we're going to flip, and we can see the lift here, and we can see the DTL broke, downward trend line, it's lifting. Take this to a daily. Do I look at relative stuff? Yeah, I do this a lot because I find great value in it. Not from, I better act now, but kind of where am I in the food chain? Am I about to be eaten or am I the predator, right? You want to know where you're at. But I find it very, very helpful. So if I look at the daily and go, all right, well, we're overbought, but we're grinding. And then I look at the 4-hour and go, is there really anything here? Yeah, we were oversold here like really fast on a relative basis, weren't we? And that has worked. Those jukes down in the past have worked in the past. So really what you have to think about is I'm looking at Nvidia relative to the NASDAQ. So if you were to say, well, on an absolute basis, whether or not to be long Nvidia, you would just look at it that way. This way, you're kind of looking at it as if I was going to buy just the NASDAQ or Nvidia, what would do better? Or if I wanted to do a pair trade. If I wanted to buy Nvidia and short the NASDAQ, because I think the market's going to go down, but I think Nvidia is the right company, this would tell you, hey, how's that going to go for you, right? So, I mean, you can see from November 24 on, it was a disaster of a trade. Like you wouldn't have made any money. A matter of fact, if you just kind of want to put it in perspective, if you looked at it from the peak down to here, if you went long Nvidia and shorted the NASDAQ, you lost 30% from that point on till you got to April 7th when it finally reversed. Something to think about. So from my perspective, I do find great value in this, but let's try and get rid of this thing for a second. Is that going to do it now? There we go. Good. So what are we learning here? Well, we're in that mid-range area, aren't we? So we're not really lighting the world on fire. Let's go take a look at it on an hourly and drill into that and see if it's telling us anything better. And it's not. It's not great. So what's this telling us right now? Yeah, semis might be moving, but should Nvidia really be our target if we're looking at the NASDAQ right now? Maybe not. And that's coming from someone that, basically breathes Nvidia. So, I actually have a little bit of a negative divergence here, don't I? So this would tell me and the reason I'm doing this is so that you can learn how I do this and maybe you find value in it. You can run your own names through the same scan. You might be like, Nvidia's for boomers. I'm all about that planter life, right? And then you might run something like this and go, yay, and see it and be all proud of yourself. So, and then you can learn how to use the tools like this, okay? So that's why I'm doing this. But let's take a look at something that has just been an absolute pig. And then this will clue us in a little bit more, and we'll go take a look at Apple, which has just been, just an absolute, utter, disgusting pig of a trade. Just can't get out of its own way. Biggest company in the world, or was, until Nvidia comes along. Someone called that on Twitter like 2 years ago. Super smart guy. Anyway, if we take a look at how this is playing out, to me, you're kind of getting to that trough valuation where Apple is relative, right? And what I would look at is something like this on the weekly. And somebody might actually say the phrase absolutely glaring when they look at this. Now, you might want more confirmation here, but you're getting there. You're certainly getting to that area. You're definitely oversold relative on Apple, and you're sitting at a level where it's held historically at that. And obviously you can see where that peak, where it gets to those peak and valleys. So if you were to go long here historically versus Apple versus the NASDAQ, you've done very well. And anyone can do this. You just divide these two and walk through it. Let's go look at this on a daily. And you'll see it even stronger in here, right? Okay. And then if you come straight across here, you just say it's sitting there. And what are you really seeing here? So I'll show you, and then you can I'm sure you saw it already, but the way that I see it is that this has just been creeping up over and over and over again and building. And what I look for when I see this kind of stuff is I look for V's. And V's are very subjective in my head. Like, to me, they are. And you might be like, I don't know what he's talking about. But V's are very subjective. But if someone showed you this, you might say that this is starting to form a V, or you might say you're dreaming and it's not, and you need to get over this level. And so what you might do is just drop a pin there and mark that off and say, hey, maybe I got to get above there because this is still a high and then this is lower. And I'm in that mid-range. So maybe I'm going to roll back over. You don't have anything definitive, but this is what you have. And I do think it's telling you a little bit of a story. So right now, someone might look at this and go, well, maybe I should buy, Apple, right? Maybe Apple's the buy right now, and maybe that's the one I should look at. And this is something else that you can do after you look at these according to the names. You can then look at them each individually with each other, and I'll show you what I mean. In front of you is Apple long, Nvidia short. How's that been working out? Well, you're at the worst valuation level that you've ever been. A matter of fact, Apple long, the last time that you wanted to be more long Apple ever would have been 2012. That was peak trade. If you look here at the peak trade and you go back to 15, since then, you didn't. Now you've had some rallies in the market when the market sold off, but really what is this telling us? Well, maybe it's telling us that, Apple's just a pig and there's no real reason to go near it. And then you kind of look at this and go, all right, well, are we getting anything from this at all? Is there anything here that we're getting from this? And the answer is, I don't really think so. I really don't. But the exercise is always fun to do and to look at. And what I would suggest is that something like this just doesn't really make any sense. You're not really seeing any semblance of this thing holding or even attempting to hold to actually challenge Apple. Where I find this really helpful is if I'm trying to figure out if I want exposure to an area. So let's say that I want exposure to semiconductors. And AMD, we all know, is just an inferior company to Nvidia, right? But then we come here and we look and go, well, it might be inferior, but it also might be breaking out on top of that. So you might not like it, but you might be setting up here for this thing to kind of start lifting. And so you start seeing this relative performance and going, well, am I going to break out of this? Because you haven't really, take a look at this on a daily. Anyone that's owned this would look at this and say, well, obviously you want to own Nvidia. Well, obviously, duh. But you do hit these pockets where you might want to look at this on, a weekly basis and go, well, here's where I'm at. And if I look at this over a course of a year, candidly, yeah. But if I look at this from 25 on, and I came here and looked at this, what's this telling me? Well, you might have periods in time where you are better off now owning AMD than you are Nvidia. And you could just kind of drop a little bit of a line here. You might actually argue that you're at the top end of that range and it's probably not the best time to do it right now. But for 2025, any time that you are at this lower band, you can all see where you are with the RSI. I'm just doing it on a 4-hour. You are much better off buying AMD at these levels versus buying Nvidia. And just to put these into perspective, if I took buying this low and selling this high, or even up here, it's 17%. So you might not think it's much, but it is. It does add up. So this might be something that's worth paying attention to. This might be an area that you may want to see if it breaks out. If you're a big AMD head, if you are, I'm sorry for you. But you just see if it just breaks here or not. And if it doesn't and it rolls back over, we'll go from there. But there is value in doing this. And you can do it, again, with any sector. It doesn't really matter. You could do it with, do I buy Oracle or do I buy Microsoft? Because I want exposure to the area. And then you're looking at it and going, well, I really want Oracle, but this is starting to get pretty negative up here. So I might want to take a look at Microsoft. And then you start looking at the names today and you're like, well, Microsoft's just a straight shot since May's earnings, right? It's just straight buying ever since. And everybody should know this because of that cloud. The cloud just crushed it here. And it's expanding, and then you have Google's earnings. You get it. So then you would look at that and then go, okay, well, how about Oracle? And you're like, well, okay, that does make sense because now we're getting this negative divergence on Oracle. Maybe it'll fix itself, maybe it won't. But Microsoft's clearly the better trader there, isn't it? Guys, I covered a lot today, a lot. And this is one of the longer videos that I've done. I'm trying to pack it all in here because there's a lot of moving parts. You need to really start wrapping noodle around that. With AI, we don't have the power that we need. We just don't. You can look at nukes, you can look at URA, you can look at NLR, you can look at any of these. And all you're going to see are market caps of stocks that people are going to try to shove themselves in. We've done exceptionally well in this space. We start looking at some of these names like SMR, and I'm buying these things at $40, and then you're 20% in a couple days. This can move a lot further than you think it can. Is there a lot of froth in this where you have these companies that are running that are bigger like this? There's no revenues here, guys, and it's bigger than LEU. Yeah, there is froth in the space. Yeah, it's going to be volatile, but this theme it's not going to go away because you need the power for AI and for these data centers. That is it.